What are ratings? What is the process? And why is it important?
See, credit rating in very simple terms is an opinion on the timely debt servicing. Right? When somebody looks at credit rating, it reflects that what is the possibility of getting the entire principal back, right? And intermittently, whatever are the periodic frequencies of the interest which are defined, are they getting that thing on timely manner or not? Yeah. In a very simple terms, that is credit rating. How it is done? In a sense, it takes care of what we call as the risk assessment framework, which has 5 main pillars. On the external risk side, it is the industry risk assessment, and it is internal risk side. You have business evaluation, which covers the operational aspects. It covers the financial risk, which is absolutely obvious on the things. It covers the project risk whenever the companies are going in for the project. And it has a qualitative assessment in the form of the management evaluation.
Wow.
So a combination of all this leads you to a symbolic representation of the risk in the form of, say, the AAA to D scale with intermittent, I can say, modifiers in the form of pluses or minuses. So there is no modifier in AAA and there is no modifier in D, right? And in C and D categories. All other categories would have plus and minus differentiators.
Yeah.
So that in a nutshell, what credit rating is and how it gets represented.
Very interesting. Let's talk about the ratings. You said, so there's AAA.
Yeah.
Which is the highest.
That's correct.
And the lowest is?
D.
Just flat D.
Yeah.
One
D for default.
D for default.
Yes.
Okay. And between that, you've got B, C, Ds and
That's
pluses and minuses.
Yes.
Pluses being obviously a good sign, minus being a negative sign, right?
Yeah.
So if I've understood this correctly, ratings are they backward looking, right? I mean, you're looking at the repayment capacity of a company. I'm assuming that most of your people that you rate are corporates, right?
Yeah.
So it's analyzing the industry, the business and much more. And the purpose is for a lender to know whether that person will repay. Have I understood that correctly?
That's correct.
So in a sense, you are forecasting based on the past. Is that a right way to look at it?
No. In fact, it is the other way around, right? Because it's not the past cash flows that define the repayment capability. It is the ability to generate the future cash flows. Because the repayment is going to be in future. It is the future cash flows that would determine the repayment capability, right?
Yeah.
But what it matters, it's a combination of the assessment of the past financials, right? As well as the projections for the future. So at the bare minimum for a long-term rating, generally we'll like to have at least 5 years projections. For a short-term rating, we could be looking at 3-year projections, so on and so forth, right? But the key aspect is that how the trajectory of the cash generations, because essentially it's a cash flow driven assessment. Right? How the past P&L, balance sheet and the cash flows are they reflective? How the future projections look like? Are there deviations from that? If the deviations are on positive side, why? If the deviations are likely to be on the negative side, why? And then we tend to sensitize those projections and arrive at our own assessment and then juxtapose that against the maturing debt liabilities which would be there over the period of assessment. So that's how in a holistic manner, the entire credit rating exercise gets completed.